To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Hello students, let's have a look at the May-23 RTP for financial reporting for CA final. We'll have a look at the questions, and if there are any specific points to be remembered, we'll try to highlight upon those, and this will serve as a very good revision for you before your examination, right? So straight away to the questions. The first one is from Ind AS 110. This is from consolidation. And for consolidation, you also need to remember the principles of Ind AS 103, which talks about how to do the acquisition date accounting, right? So here we have High Speed Limited, which manufactures and sells car. Okay, this is one company. The company wants to foray into two-wheeler business. Okay, therefore it acquires 30% stake in Quick Bikes Limited for 5 lakhs. So first acquisition is 30% for 5 lakhs on 1st of November. And an additional 25% stake as at 1st of January for 5 lakhs. So another 25% on 1st of January. When did the control come into picture, or when did High Speed Limited start controlling Quick Bikes? It is on 1st of January when it gets the controlling stake, that is 30 plus 25, 55%, right? On this date the control happens. Now please remember, on the date of acquisition of control, you have to do the acquisition date accounting as per Ind AS 103. That is, you will take fair value of existing stake, then you will need fair value of consideration, then you will need NCI. Now NCI, value of NCI, depends whether it is proportionate share of net assets or fair value basis, that will be given in the question. Then you need fair value of identifiable net assets. All of these things is what we need. Okay. Now 5 lakhs is fair value for 25% stake. Now what does that mean? If 5 lakhs is fair value for 25% stake, means 100% stake is what? 20 lakhs. So existing 30% stake will be 6 lakhs, right? 20 lakhs multiplied by 30%, 6 lakhs. Cost of this 30% is 5 lakhs. So there will be a gain of 1 lakh. That's the first part. Because whenever an entity acquires control, the existing stake has to be fair valued. This gain of 1 lakh will be taken to P&L or OCI depending on the classification as per Ind AS 109. See, at a final level, it is not only looking at one standard. You have to understand the synthesis of multiple standards, right? Now P&L or OCI depending on the classification which is chosen by the entity. This is done. Then existing stake, new stake that they have acquired 5 lakhs, that's also given. Then balance sheet of Quick Bikes is given, carrying value is given, fair value is given. Okay, so we will use the fair value for the purpose of calculation of goodwill or capital reserve. Then Quick Bikes sells motorcycles under the brand Superstart, which has a fair value of 3,50,000. So what is this? This is an intangible asset which is valued at 350. This is self-generated. Now as per Ind AS 38, self-generated intangible asset will not be appearing in the books. But for the purpose of Ind AS 103, when you do the initial acquisition accounting, you will find out what is the value of the identifiable net asset, and this value you will incorporate while calculating goodwill or capital reserve, right? So they have not recognized. Now what is the treatment we need to do? We need to consider while calculating goodwill or capital reserve. The separate balance sheet of High Speed is given, the various items are given. Okay. In relation to the acquisition of Quick Bikes Limited, you are required to pass necessary journal entries to give effect of business combination in accordance with Ind AS 103 as an acquisition. NCI is measured by the entity at fair value. So what is NCI? See, 55% is control, 45% is NCI. If 45% is NCI, then 45% of 20 lakhs, 9 lakhs is your NCI number, right? Ignore deferred taxation, very good. Prepare consolidated balance sheet as on 1st of January. See, once you calculate this 9 lakhs correctly, once you identify that yes, this 350 has to be taken, and you take this net assets at fair value, remaining thing becomes very, very easy, right? So now 750 plus 50, 8 plus 5, 13 lakhs is this side, plus, so I'll just note it here, net assets 13 lakhs plus brand 3.5 lakhs, this is 16.5 less, how much is the liability? 1.5. So 15 lakhs is the identifiable net asset, this is your net asset. Then on the other side what do you have? Fair value of consideration 5 lakhs, fair value of stake. Now you have how much stake? Existing stake. Existing stake is 30%. So 30% stake will be 30% multiplied by 20 lakhs, that is 6 lakhs. NCI is how much? NCI we calculated 9 lakhs. So total of this is 20 lakhs. Right? This is 20 lakhs, this is 15 lakhs. The difference between these two is your goodwill. How much is goodwill? 5 lakhs is your goodwill. Right. So let's see how do we provide the solution for this. Initial date accounting, plant and equipment debit 7,50,000, which is the fair value. Investment fair value 5 lakhs, trade receivable 50,000, brand 350, goodwill 5 lakhs. 2. Investment in quick bikes 10 lakhs. Now why this investment in quick bikes is credited? Because when you are consolidating, please remember this entry is passed in the consolidated books. So when you are consolidating, investment is no longer required. So whatever is the cost of investment, you will de-recognize that. To P&L 1 lakh. What is this P&L 1 lakh? The gain. See, 5 lakh is the cost, 6 lakhs is the fair value. The difference of 1 lakh, it can be to P&L or it can be to OCI. Then to trade payables 150 and to non-controlling interest 9 lakh. So all of this we have calculated. You can look at the working notes as well, right? Then net assets we have already done. Consolidated balance sheet. Now in the consolidated balance sheet, there is no challenge at all. What you need to do is, you just need to take, for example, 750 fair value, 1350 here, 13 plus 7, 20, 21 lakhs of PPE. Then intangible asset 850. What are these intangible asset? Goodwill 5 lakhs, 3,50,000 of brand. Then investment in bond at fair value, trade receivable at both the companies. Just keep on adding line by line and you will get the balance sheet. I don't think I need to spend more time on this because this is a straightforward thing. Now in the examination, ensure to do the balance sheet in the proper format. Though the question is given in this format, you have to use the schedule 3 format and you should give the notes as well, right? Then moving on to the next question. Ind AS 2. Next question on Ind AS 2. An entity has the following details regarding cost and retail price of the goods purchased and unsold at the beginning of the year. Opening inventory 6250 at cost, price is 8,000, purchase is 19,500, retail price is 34,000, inventory on hand 23,000, sales for the period 19,000, right? So this is the information given. Then apply the retail method and compute the following: percentage of cost price over retail price, cost of closing inventory, value of cost of sales, and profit earned during the year on sale of inventory. Ignore the impact of markups or markdowns on the selling price. So ignore what will be the discount and all given. Purely compare the retail price with the over the cost price, right? Now here, what is the question wanting us to solve? Cost price over the retail price. What is the cost? Cost is these two. 6250 plus 19,500. So 19 plus 6 is 25. 25,750 is the cost. Sale price is 34 plus 8. See, for the opening inventory and purchases, means for the goods that we have, sale price is 8 plus 34. 8 plus 34, which is 42,000, right? So now percentage of cost price over retail price. So basically what is the percentage of this? 25,750 divided by 42,000. So if you do 25,750 divided by 42,000, you get 61%. So this is what is percentage of cost price over retail price. Then what is the cost of closing inventory? So for cost of closing inventory, what you need to do is, you have the retail price of 23,000, right? If you see, 23,000 is the retail price of the inventory. So if 23,000 is the retail price, cost is how much? 61%. So 61% of 23,000, that is 14,030 is the cost of inventory. And what is the value of cost of sales? See, cost of sales is your opening stock plus purchases minus closing stock. So what is the opening stock at cost? 6250 plus what is the purchases? 19,500 minus what is the closing stock? 14,030. So whatever is the number, if you just see the solution, we can get it, right? 11,720. So this is 11,720 and profit earned during the year on sale of inventory, right? So profit is how much? 19,000 whatever has been sold minus this cost of 11,720. The difference will be your profit, right? So this is another question. unique type of question, but very simple and logical. Now moving on to the next one, which is very important, Ind AS 19. In fact, on this Ind AS 19, the full standard is available on YouTube. If you have any problem, I used to actually be scared of this standard. We used to have AS 15. Okay, it was a really scary standard. That's why I have given this entire standard of about 8 hours of content, fully animated, is available on YouTube for free. All the study material questions and in-depth conceptual clarity. Okay, so if you want, you can actually have a look at that. Right. So let's see what is the question here. From the following particulars, compute the net defined benefit liability and expense to be recognized in P&L, right. Most of the times from Ind AS 19, this is the question you get, and if you remember or if you are able to logically understand what is the expense, what is the liability, what is the asset, it becomes very easy. Okay. So now they have given benefit obligation and plan assets, beginning of the year 31st December year 1, year 2. Okay, what is the defined benefit obligation? So for year ended 31st December of year 1, opening balance was this much. Current service cost, always remember, current service cost increases the benefit obligation. Then interest cost, this also increases the obligation. Change in demographic assumptions, these are your actual assumptions which change. Here also it has increased because these are expense. Change in financial assumptions, 3.58, 1.93. Then experience variance. So basically, as you move further into the future, your actuals are different from what you would have thought. Hence, there is a variance to this extent. Here there is a negative number, positive number. Negative is reduction in liability, positive is increase in liability. Benefits paid, these are actually settlement, 0.61. Always remember, when a benefit is settled, you will reduce from obligation as well as from the asset. Investment income, 1.12, 1.147. Employer's contribution, you have received contributions of 7 and 8. And return on plan assets is 0.35 and 2.12, right. So these are the components on the asset side. Now what is the question? The question is, compute the net defined benefit liability and expenses to be recognized in the P&L, right. So that is what is the question, very simple. Now what I'll do is I'll actually use an Excel because it becomes easy for us to calculate. See, you need to understand the logic. Calculator and all calculation you'll be able to do anyways. So we have been given 2 years data, year 2 and year 1. So this is for year 2 and this is for year 1. Okay. Now looking at the question, balance at the beginning, opening balance is given 47.08 and 63.25, that is the defined benefit obligation, and you have plan assets of 21.8 and 14.65, right. So obligations and plan assets. Okay, opening balance. How much is the opening balance? 63.25, 47.08. So 47.08 and 63.25, and plan assets is 21.80 and 14.65. Right. Now current service cost increases. So it increases your obligation. Okay. So how much is that? 5.84 and 4.97. Then interest cost will also increase. What will it increase? It will increase your obligation. Interest cost, it will increase your obligation because you are adding it to your opening balance of liability. So how much is that? 4.27 and 3.56, right. Then changes in demographic assumptions, (0.62) and 1.86. Then changes in financial assumptions, 3.58 and 1.93. Then experience variance, minus 2.49 and 4.46. Benefits paid, that is what is actually paid to the employees, 0.61, right. Now this is the obligation part. Now if you see the closing balance, it is just a summation of all of this. Okay, and in examination, because the question, what is the question? The question is about compute the net defined benefit liability. So you just need to compute the net defined benefit liability. They have already given the breakup. So no need to do this activity all over again. You can just say net defined benefit liability is this, which is basically your assets minus liability, and the expense to be recognized, that is what we will be computing. Okay. So here it is 63.25, which itself is the opening balance you can see here, and closing balance is 75.07. Now in the question they have not calculated the closing balance, so that is why we have to do this activity of 75.07. Now coming to plan assets again, so there is no movement, only thing is you have income and you have the payouts, right? So this benefit paid will reduce the plan asset, which is minus 0.61. Then you have income. How much is the income? Income is 1.47 and 1.12. Then you have employer's contribution. See, employer's contribution will increase your plan asset because they have added it to the kitty, they have added it to the investment pool, so the assets will increase, right? So contribution, which is how much? 8 and 7, 7, and return on plan assets. Actually this income and return on plan assets should be combined and given, but they have given it separately. Return on plan assets 2.12 and 0.35. This is negative, minus 0.35, right? So if you do the total here to row number 12, 33.39 and 21.81. So here they have said in the question they have given 21.80. Okay, so we will consider 21.80 and do it. So 21.81 and 33.39. Now the question is the net defined benefit obligation which will be recognized. So how will you recognize? Net defined benefit obligation is your obligation minus plan asset. So that is 41.68 for the, this is for the current period. Previous period 41.44. How did you get 41.44? Which is nothing but 63.25 minus 21.18, right? So that is the defined benefit obligation or the net defined benefit obligation. That is the first part. Then now expense to be recognized, if you see, would be what? Your current service cost. It is an expense. You will recognize this. Interest cost is an expense which will be recognized. Now the question, if you see, says to be recognized in P&L. Very important, to be recognized in P&L. So those numbers which will go to OCI, that you should not be computing. So what all will go to P&L? Current service cost, interest cost. Where will the changes in, you know, demographic assumption or financial assumption or experience variance go? All of that will go to OCI, right? Benefit paid is not an expense. Then here you have income, right? So here you have income of 1.47 and 1.12. That 1.47 and 1.12, whatever is your income, will be a reduction, from the expense, right? So when you look at the expense to be recognized, it will be, I'll just do the working for you, 5.84 plus 4.27 minus 1.47. So 8.64 in year 2 and 7.41 in year 1. Basically the sum of these two minus the investment income. Other adjustments will go to OCI. Other adjustments will go to other comprehensive income. They have asked us only about P&L, right? So let's move to the third question. Ind AS 102, again a very important standard. Entity A runs a copper mining business. Entity A has a year end of 31st March. Dividends declared on the shares accrue to the employees during the 3-year period. Okay, so whatever is the dividend which is declared on the shares, they accrue to the employees during the 3-year period. If the condition is met, the employees will receive the shares together with the dividends that have been declared on those shares during the 3 years up to 31st of March. So what has happened? If the condition is met, they will not only receive the shares, but dividends also will be paid. Okay. The entity estimates that on 1st of April of year 0, its shares are valued at rupees 10 each. The grant date fair amount of each share is rupees 10. So, this is the grant date fair value of each of the share, which is rupees 10. Okay. Entity A prepares annual financial statement for the year ended 31st of March, and on 1st April it estimates that 800 shares will vest. So, that is the initial date you have made the assumption. At the end of the first year, it has revised its estimate to 780. At 31st March of year 2, it has further revised this estimate to 750, and 750 shares vest on 31st of March of year 3. So, if you look at a timeline, 1, 2, 3. Okay. So, here when they started, what did they say? They said 800, then 780 and 750. 800, 780 and 750. Right. So, this is 0, this is year 1, year 2 and year 3. At year 3, ultimately 750 shares vest. On 1st April, as a part of long-term incentive scheme, Entity A provisionally awards its sale employees 1000 Entity A's shares receivable on 31st March of year 3. Explain the accounting treatment for the above share-based awards based on satisfaction of the condition that sales employee must remain in employment until 31st March of year 3. The requirement to remain in employment is a service condition and would not be reflected in the fair value of the share awards. So, what has happened here? Now, at the end of year 1, that is when you are accounting for on 31st of March of year 1, number of shares expected to vest is 780, right? Fair value at grant date is 10, total is 780 multiplied by 10, 7800, number of years 3, expense will be 7800 divided by 3, 2600 is the expense in the first year. Then come to second year, 31st March of year 2, at that point vesting expectation is 750. So, 750. Fair value at grant date is 10, total is 7500, number of years is 3, expense should be 7500 multiplied by 3 divided by 3 multiplied by 2, which is 5000. So, this is cumulative. Expense will be 5000 minus 2600 to this 2400. Then in year 3, 750, 10, 7500, 3 years, this will be multiplied by 3 and balance 2500 will be expensed in the third year. Right, very simple and straightforward, nothing complicated. Then Ind AS 101, ABC Limited, a public limited company, is in the business of exploration and production of oil and gas and other hydrocarbon related activities outside India. It operates overseas projects directly and or through subsidiaries by participation in various joint arrangements and investment in associates. The company was following accounting standards as notified under the company's accounting standard rules until 31st March. However, it has adopted Ind AS with effect from 1st of April. So, earlier they are following AS, now they are following Ind AS. Okay. The goodwill recognized in accordance with AS 21, this deals with consolidation, and 27, the joint venture, was due to corporate structure and the line by line consolidation of subsidiaries and proportionate consolidation of jointly controlled entities' financial statements, which was prepared on the historical cost convention. ABC Limited has not taken into consideration the valuation of underlying oil and gas reserves for which excess amount has been paid by the company at the time of acquisition. So, they have not taken into consideration the valuation of underlying oil and gas. So, if you are acquiring an oil well, let us say this is a well, okay, and not the well where you draw water from, oil wells basically. When you are acquiring this well or when you are acquiring a company, you are paying for what? For the oil also inside the well, but they have not taken into consideration the valuation of underlying oil and gas reserve for which excess amount has been paid. So, let us say we paid 100, okay, net assets is 30. So, what do we say? 70 is goodwill, but there is something which is there as form of oil which is not considered here, okay. So that is what is the difference that they are facing, or that is what is the challenge they are facing. So that is what they have not considered, and hence goodwill is overstated. Okay. The company further considered that in oil and gas companies, the goodwill generated on acquisition of mineral rights either through JCE, jointly controlled entities, or subsidiaries inherently derives its value from the underlying mineral rights, and accordingly value of such goodwill depletes as the underlying mineral resources are extracted. So the logic is that goodwill, whatever is there, it is dependent on the oil reserves, and as we extract oil reserves, the goodwill will also be depleted. If you remember, under accounting standards, you amortize goodwill. Okay, if there is amalgamation and you recognize goodwill, that is amortized. Here you don't amortize. Here you will do impairment testing. Therefore, taking a prudent approach and considering the above substance, the company amortized the goodwill in respect of its subsidiaries over the life of the underlying mineral rights using unit of production method. This is not allowed under Ind AS, right? Then, this allowed the company to utilize the value of goodwill over the life of mineral rights, completely charging off the goodwill over the life of the reserves. For the financial year ended year 1, the company has availed transition exemption under Ind AS 101 and has not applied the principles of Ind AS 103. So now we know, as per exemption, you can take the exemption and not apply the principles of Ind AS 103, provided for all the acquisitions before that acquisition you don't apply Ind AS 103. ABC Limited, considering the substance over the form of goodwill to be in the nature of acquisition cost, intends to continue amortization of goodwill recognized under AS in respect of its subsidiaries and joint ventures over the life of the underlying mineral rights, unit of production method under Ind AS also post transition. Comment on appropriateness of the accounting treatment under Ind AS for amortization of goodwill by the company, and state whether the accounting treatment in respect of amortization of goodwill is correct or not. So much of Ramayana, and finally the question is, can we amortize the goodwill or not? See, these are what? These are your case study based question, what they generally give in electives and all. From there they have taken a big case study kind of a thing, and this is something which helps students to apply the principles what they have learned, right? Ultimately, when you start reading this long question about so much of information, they are doing they have done this, they have done that. Ultimately, what is it? It is about whether the amortization of goodwill is correct or not. The company wants to avail the transition exemption. Can they avail transition exemption? Yes, they can absolutely avail transition exemption. There is no problem in that. But then, please remember, you can avail the transition exemption and you can carry the goodwill or any other, and you can carry the goodwill at its previous GAAP carrying amount, but here they have calculated, but here they have not considered this underlying oil and gas reserves for which excess amount has been paid. So as I told you, 100 is the amount paid, 30 is the asset. For oil, we have paid some extra amount that is not included here. We have said entire 70 is goodwill, but this is not correct. You have to see what is the value of this oil and gas reserves. So let us say this is 20. So 100 minus 30 minus 20, 50 should be the value of goodwill. So first adjustment that has to be done is you have to reduce the value of goodwill and identify or recognize another identifiable asset, which is an intangible asset representing the oil and gas reserves related rights. That's the first thing. Once that is done, the balance amount of goodwill can be carried as per the previous carrying amount or as per the previous GAAP. Second thing is, you have done the transition exemption is availed, but after the transition, you cannot amortize goodwill as per the previous GAAP. Okay, so as per Ind AS, goodwill cannot be amortized. What can we do? Goodwill has to be tested for impairment. So you will do the goodwill testing for impairment annually as per Ind AS 36, and you will not amortize the goodwill. Every period you have to test for impairment, right? So that is one important aspect which you have to highlight here. As I told you, the main part relates to impairment, and this cannot be done, amortization cannot be done, the accounting treatment is not correct. So let us see how do we present the answer. The carrying amount of goodwill or capital reserve in the opening Ind AS balance sheet shall be its carrying amount in accordance with the previous GAAP at the date of transition to Ind AS after 2 adjustments. One of the adjustments states that the standard requires the first time adopter to recognize an intangible asset that was subsumed in recognized goodwill or capital reserve in accordance with previous GAAP. the first time adopter shall decrease the carrying amount of goodwill or increase the carrying amount of capital reserve accordingly. Meaning to say, if there is some other asset inside goodwill, remove that asset out and then adjust the amount of goodwill. The entity has paid excess amounts to avail right to use underlying oil and gas reserves. However, since the rights was not recorded in the books at that time, the value of goodwill subsumed the value of that intangible asset, which should be separately identified in the books. Hence, the value of goodwill will be reduced. Then, it has to be tested for impairment as per Ind AS 36, and once goodwill is recognized in the opening transition date balance sheet, the entity has to follow the provisions of Ind AS, which states that goodwill cannot be amortized, but it will be tested for impairment annually, right. Let us look at the next question. It's from Ind AS 115, which deals with revenue recognition. Company X enters into an agreement on 1st of January of year 1 with a customer for renovation of hospital and install new air conditioners for total consideration of 50 lakhs. So, this is the total consideration. The promised renovation service, including the installation of new AC, is single performance obligation satisfied over a period of time. So, they themselves have said it is satisfied over time. Total expected cost are 40 lakhs, including 10 lakhs for the air conditioner. So, total cost 40. If you break it up, AC is 10 and 30 is other cost. Company X determines that it acts as a principal in accordance with Ind AS 115 because it obtains the control of the AC before they are transferred to the customer. Now, in these situations, what happens is they have taken control of the AC. They have taken control of the AC first. The company takes control of the AC and then they are transferred to the customer. So, basically, they are delivering the AC. The customer obtains the control of the air conditioners when they are delivered to the hospital premises. Company X uses an input method based on cost incurred to measure its progress towards completed satisfaction of the PO. As at 31st March, other costs incurred excluding the AC are 6 lakhs. Whether Company X should include the cost of AC in measure of its progress of performance obligation, how should the revenue be recognized for the year ended 31st March? Now, this we have discussed in class in very much detail as well, that whenever these kind of scenarios arise, when one is a performance obligation satisfied over a period of time and then you have something worth 10 lakhs which is delivered. The moment it is delivered, can we say that this 10 lakh worth of work has been completed? See, that is an AC. The equipment the entity purchases and delivers it to the customer. Now, if I say, see, if you see this 10 lakhs out of 40 lakhs, 25%. Can I say 25% of the work is completed? It may not be completed because the installation of AC might be pending, and this is just a case where the entity itself is acting as a principal. So, it can deliver it. So, just to increase the revenue, it can simply deliver it beforehand also. Now, here we have understood that when the company acts as a principal to deliver this particular piece, that is 10 lakhs, okay, it can deliver it or it can prepone the delivery just to show that, okay, we have completed the part, right, because it just requires delivery. So, if you take the input is 40, the total expected cost, output is 50, for 50 minus 40, 10 is the profit. Just by delivering this AC, right, which is worth 10 lakhs out of a total cost of 40 lakhs, they may say that, okay, we have completed 25% performance obligation. In such scenario, what is appropriate? It is appropriate to exclude this 10 lakhs from the input, exclude this 10 lakh from the input. So, for the purpose of revenue recognition, we will say obligation completed 6 lakhs out of 30 lakhs, right, obligation completed 6 lakhs out of 30 lakhs, which means 20% work is completed. 20% work is completed. Then, how much of revenue will be recognized? See, this is a piece of machine to be delivered. The total revenue from renovation would be 50 lakhs minus 10 lakhs, which is 40 lakhs. So, 40 lakhs is the renovation related work. So, 20% of 40 lakhs should be recognized as far as the 40 lakhs, I wrote I think 4 lakhs. So, 20% of 40 lakhs, 8 lakhs should be the revenue from renovation. Cost of AC delivered to the extent of cost, recognized revenue. So, total revenue to be recognized will be 18 lakhs. Okay. How much will be the cost? 10 lakhs for AC and 6 lakhs for other cost. So, 2 lakhs will be your profit, right. So, that is how you have to do when the entity acts as a principal and they obtain control of the equipment before the equipment is delivered to the customer, and control is passed, when the equipment is handed over to the customer, and if that represents a significant portion, by saying that this 10 lakhs is completed for the renovation purpose, then it will distort the revenue picture. What is the meaning of that is, if we say 10 lakhs plus 6 lakhs, if 16 lakhs we say is completed, 16 lakhs out of expected 40 lakhs if we say completed, then it will be 25% complete. Okay. No, 40% complete, sorry, 40 into 16, we would say 40% complete. Then 40% complete means we will recognize 20 lakhs of revenue, whereas under the prudence basis, we will be recognizing only 18 lakhs of revenue, because it is just a delivery related thing. You are not doing any more work. So, you are splitting between the equipment delivery and the renovation part. Then Ind AS 16 should be pretty simple and straightforward. Company X built a new plant that was brought into use on 1st of April. The cost to construct the plant was 1.5 crore. The estimated useful life of the plant is 20 years, and the company accounts for the plant using cost methods. Okay. Initial carrying amount of the plant included an amount of 10 lakh for decommissioning, which was determined using a discount rate of 10%. On 31st March, company remeasures the provision for decommissioning to 13 lakhs. Provide necessary journal entries at the end of the year, that is 31st March of year 2, recording of depreciation and decommissioning provision. So, when was it purchased? 1st of April of year 1. Okay. Now, provisioning, and how much is that included? 10 lakhs. So, present value of decommissioning is 10 lakhs, right. On this you will charge interest at 10% for 1 year, which is 10 lakhs multiplied by 10%. Closing balance should be 10 lakhs plus 1 lakhs, which is 11. Revised provision at year 2, what they have said? They remeasure the provision to 13 lakhs. So, additional provision is 13 minus 11, which is 2 lakhs. Now, this 2 lakhs will be debited to PPE and credited to provisioning. Okay, debited to PPE, credited to provision for decommissioning. That is very simple. Then what have they asked? They have asked necessary journal entries. So, what are the journal entries? First one is interest expense. So, interest expense 1 lakh, depreciation. So, depreciation based on the cost. What is the cost given? The cost to construct the plant was 1.5 crores. The estimated useful life is 20 years. Initial carrying amount included 10 lakhs. So, don't go ahead and add 10 lakhs again. Okay, that is included in it. So, 1.5 and a useful life of how much? 20 years. So, 1.5 divided by 20, 7.5 lakhs. Interest expense to provision 1 lakh, and the extra provision plan to provision for decommissioning 2 lakhs each, right. Simple. Then next one is on Ind AS 20. A Limited received a government grant of rupees 10 lakhs to defray expenses for environmental protection. Expected environmental cost to be incurred is 3 lakhs per annum for the next 5 years. How should A Limited present such grant related to income in its financial statement? Now, they have already received 10 lakhs, and what is the thing? They have to defray expenses, means they have to spend money on what? Environmental protection, 3 lakhs per year. So, that is what they have to spend. How should such grant be presented? How should A Limited present such grant related to income in its financial statement? So, whenever you receive a grant where you have to meet certain conditions in the future, it has to be set up as a deferred grant account, right. So, accounting for deferred grant. So, grants related to income are presented as a part of profit or loss, either separately or under a general heading other income, or alternatively they are deducted from the related expense. In accordance with the above, the grant can be presented as below. First, credit in statement of P&L. The entity can recognize the grant as income on a straight line basis, which is 2 lakhs in the statement of P&L. Now, why 2 lakhs? Because 10 lakhs is the grant. Every year 3 lakhs for 5 years. So, 3 lakhs is the expense. Over 5 years, 2 lakhs will be the income which will be recognized. If this ratio is different, in that ratio you will recognize. Here it is 3 lakhs, every year expense is 3 lakhs, so 2 lakhs per year, right. Then, so you can recognize it on a straight line basis under other income. Other option is 3 lakhs minus 2 lakh, 1 lakh you can put it up, right. So, either ways you can put it up and give a proper disclosure as to which method has the entity followed. Then, Ind AS 116 on leases. How will entity Y account for the incentive in the following scenarios? Scenario A. Entity Y lessor enters into an operating lease of property with entity X for a 5-year term at a monthly rental of 1,10,000. In order to induce entity X to enter into the lease, entity Y provides 6 lakhs to entity X at lease commencement for lessee improvements, that is lessee's assets. So, entity Y, question is what? Entity Y. Entity Y has given what? Entity Y has given 6 lakhs for lessee's asset. Now, in that case, can entity Y say these are its asset? Can entity Y say that is my asset? It cannot say, because control is with lessee. So, it is not an asset which the entity can recognize. Basically, if lessor pays for, let us say, furniture, whose furniture? Lessee's furniture. Now, if lessor is paying for lessee's furniture, does lessor control the furniture? Lessor does not control the furniture. So, lessor cannot recognize the furniture as an asset, right. Then, next scenario, entity Y enters into an operating lease of property with entity X for a 5-year term at a monthly rental of 1,10,000. At lease commencement, entity Y provides 6 lakhs to entity X for leasehold improvements which will be owned by entity Y. The estimated useful life of the leasehold improvement is 5 years. In the second scenario, it is the lessor's asset. I can say it is under my control, so I can capitalize that. Now here this is also an operating lease, this is also an operating lease. Monthly rental 1,10,000, 1,10,000. Only difference is here you are spending 6 lakhs, not getting anything. You are giving 6 lakhs, you are not getting anything. Here you are spending 6 lakhs and you are getting an asset. So here definitely you can add it to PPE. Right, here definitely you can add it to PP. What is to be done here? See, for lessor, if it is an operating lease, you will recognize the income on SLM basis. Now here, you have given 6 lakhs upfront for how many years? 5 years. So 6 lakhs of amount that you have given as incentive upfront over a period of 5 years, that is 60 months. Each month you will recognize an expense of 10,000. So what you will do is, whatever is the amount that is paid, it is a lease incentive which is deferred, credit to cash. And every period you will say, okay, you will receive 1,10,000, no? Out of that 1,10,000, only 1 lakh will be your net income, because 10,000 is something which you have already given back per month. So think of it, I gave 6 lakhs upfront, forget the discounting factor because it's an operating lease. I have given 6 lakhs upfront. Every period I will collect 1,10,000. In that, 10,000 is something which I have already spent earlier, which I am getting back. So my net income per period will be 1 lakh only, right. So when the lease incentive is given, you will say deferred lease incentive to cash. Then when you get the money, cash 1,10,000, lease income 1 lakh, and balance deferred lease income 10,000, because you have given an incentive which has not created an asset. In the second case, because it has created an asset, you will say PPE to cash, and lease income will be recognized at 1,10,000. And of course, you will depreciate this asset of 6 lakhs over the useful. The next one, Ind AS 103. In October of year 1, IHL acquired 75% of Very Relevant Limited by paying cash consideration of 0.8 million. The fair value of non-controlling interest on the date of acquisition is 0.2 million. The value of Very Relevant Limited identifiable net asset as per Ind AS 103 is 1.1 million. So what they have given? 75% acquisition. The fair value of NCI is 0.2. So 0.2 is NCI. Consideration paid is how much? 0.8. Then the value of Very Limited identifiable net asset is 1.1. So this is 1. Net asset is 1.1. Now 1 minus 1.1, 0.1 is what? See, you have paid 1, you have got assets worth 0.1. So this is a capital reserve of 0.1. With respect to acquisition of Very Relevant Limited, determine the value of gain or on bargain purchase when NCI is measured as per fair value. So fair value if you measure, you get 0.1 of gain. Proportionate share of net identifiable asset method. Now here what will happen is, non-controlling interest is 25% of 1.1 million. So 25% of 1.1 gives you 0.275. Consideration paid is 0.8. So, this becomes, this is non-controlling, this is consideration paid, 1.075. Net asset is how much? 1.1. So, 1.1. So, 1.075 minus 1.1, you have a gain of 0.025 million, bargain purchase gain. Simple, that's nothing complicated. Then Fisheries Limited practices pisciculture. We used to study as a part of our school curriculum. In sweet water ponds, tanks and dams, the fishing activity of Fisheries Limited in such sweet water consists only of catching the fishes. Comment whether such fishing activity will be covered within the scope of Ind AS 41. Now, when you cover something under Ind AS 41 as per agricultural activity, there has to be active management. We are not doing any active management. There is a sweet water pond, we will go and we will do the fishing. Is that an agricultural activity? It is not an agricultural activity. It will not be covered under Ind AS 41. So, here is the management by an entity of the biological transformation and harvest of biological asset for sale or conversion into agricultural produce or into additional biological assets. For fishing to qualify as agricultural activity, it must satisfy management of biological transformation and harvesting of biological asset for sale or conversion. When fishing involves managed activity, then it is agricultural activity. Here they are only doing harvesting. So, hence it is not an agricultural activity. Then coming to Ind AS 32. State whether the following items meet the definition of financial asset or financial liability for an entity. Now, few things for you to quickly remember. Whenever we say it is a financial asset, there has to be cash or right to cash, right to receive cash, or it has to be something which is beneficial. Okay, it has to be something which is a beneficial thing. And if there is something which is fixed to fixed in exchanging shares, it will be equity. If it is not fixed to fixed, then it is a liability or an asset depending on the category, right? If it is a derivative, you have to see whether you are in gain or loss. Quick summary. A bank advances an entity a 5-year loan. The bank also provides the entity with an overdraft facility for a number of years. Now, for an entity, here bank advances 5-year loan. So, you have received a loan. There is an obligation to pay cash. Hence, it is a financial liability. Entity A owns preference shares in entity B. The preference shares entitles entity A to dividends but not to any voting rights. So, there is dividend, there are no voting rights, okay. They have not mentioned about whether it is redeemable, irredeemable, that is one thing. If it is in Indian context, the preference shares are redeemable and hence it can be a financial liability, and also dividend part is a financial liability, right. Now, here they have not said for an entity. Now, which entity? Entity A or entity B? See, the classification, should it be from entity A or entity B? So, for entity A, here it is a financial asset. For entity B, it is a financial liability. Or if it is irredeemable, which is not allowed in India, it can be an equity component as well. Dividend part is a financial liability. So, let us see what they have taken as an assumption. The preference shares may be equity instruments or financial liabilities depending on the terms and conditions. So, this is based on the global perspective, okay. For entity A, preference shares are financial asset, right, that is what we have done. Then, an entity A has a present obligation in respect of income tax due for the prior period. Now, here do not go by the term obligation, go by the term contract. Is there a contract? There is no contract. So, it is not a financial asset, it is not a financial liability. Then, in a lawsuit brought against an entity, a group of people is seeking compensation for damage to their health as a result of land contamination believed to be caused by waste from the entity's production process. It is unclear whether the entity is the source of the contamination, since many entities operate in the same area and produce similar waste. Now, here there is a lawsuit. Lawsuit is a contingent liability, right? Lawsuit is a contingent liability. Now, is there any probability outcome given? Nothing given. Where will we take this? We will take it to Ind AS 37. That is the first thing. Second, is there any contract? See, just because there is a contingent liability does not mean it's a financial liability. I know there is outflow of resources, but is there a contract? There is no contract. So, because there is no contract, you cannot call it to be a financial liability. You will take it under Ind AS 37 and accordingly you will account for it.